In this session on period end adjustments, we're going to have a look at accruals. Now, when an accountant prepares a set of accounts for a particular period, usually a year, that accountant needs to make sure that the statement of profit and loss includes all of the income that business has generated in that accounting period, and it also needs to make sure that all of the expenses incurred in that accounting period are also included. This approach is known as the accruals concept, where we match income and expenses to the accounting periods in which they were actually incurred or generated. But the problem is that sometimes at the end of an accounting period, we might find that certain types of financial transactions have taken place, but they're not recorded in either the day books or the cash book until the next accounting period, so after the end of that accounting period. Let me give you an illustration so that it's clear. So let's say that we have a business with a year end of 31st of December 2017, and that business has received and accepted goods costing £2,000 from a supplier, and they were received before the year end on the 27th of December. The supplier then issued an invoice on the 4th of January 2018. So that invoice was issued and received after the year end. So that purchase would actually be recorded in our purchase day book in January 2018, not December when the goods were actually received. The problem with this situation is that in our books, the cost is going to be recorded in January, but it was actually incurred in the year ended 31st of December 2017, in the previous period. So we need to find a way to make sure that this cost is included in our accounts for the year ended 31st of December 2017. So to solve this problem, we're going to do two things. First of all, we're going to record an adjustment at the period end, so on the 31st of December 2017, to record that additional cost, because otherwise it'll be recorded in the wrong accounting period. And this adjustment here is known as an accrual. Secondly, at the start of the next accounting period, so on the 1st of January 2018, we're going to reverse that adjustment we put through at the end of the previous year. If we don't do that, what will happen is that we'll end up double counting this cost, because we'll have included it in the year ended 31st of December 2017 via this accrual, but we'd also record it again via the purchase day book where the invoice is recorded in 2018. So hopefully that has illustrated the problem and the general way in which we're going to solve it. Now, in my previous example, our business knew the exact amount of the expense or cost that had to be accrued, £2,000. It was very clear, the amount. But this isn't always the case, because often we receive bills for goods or services that cover a period of time, and it might not be that obvious initially how much of that cost relates to one accounting period and how much of that cost relates to the next accounting period. So let's have a look at an example, and then we'll explain how we deal with this issue. So let's say that the business pays its bank charges quarterly, so that's every 3 months. And the last amount paid in the year ended 31st of December 2017 was for the quarter ended 30th of November 2017. So this business will have paid that at the end of November, and then The next lot of bank charges would be paid on the 28th of February 2018, and that would cover the months December, January and February. So in the year ended 31st of December 2017, we need to accrue for the bank charges that will have been incurred in December. But how do we calculate that amount? Well, we would normally identify the amount of bank charges that were paid for the quarter ended 28th of February 2018, and then we'd time apportion that amount. So that amount that was paid in February would be for 3 months. So we would simply take a third of that amount as being the accrual that was needed for December. Of course, when the accounts are being prepared, we might not have that information. So for instance, this business was preparing its accounts for the year ended 31st of December 2017 at the start of January. We would not know at that stage how much was going to be paid at the end of February. So as an alternative in that situation, what we could do is we could look at the amount that was paid for the quarter ended 30th of November 2017 and take a third of that, and that should represent a reasonable estimate for the bank charges in December. Do remember that often when we calculate accruals, we end up having to estimate. So having described what accruals are and how they can be calculated, let's have a look at a couple of examples to show how we would go about recording an accrued expense and an accrued income at the end of an accounting period, and how we would then go about reversing that at the start of the next accounting period. So we'll start with an accrued expense. Here we've got a business with a year end of 31st of May 2018, and just after the year end it pays bank charges of £200, all of which related to the 3 months ending 31st of May 2018. So that cost will be recorded in the cash book after the year end, but it relates to costs that were incurred in our year ended 31st of May 2018. So what we'll have to do, we'll have to record an accrual so that that expense is recorded in the correct accounting period. So let's have a look at the journal that we would record. We would debit our bank charges with £200. That would then increase the bank charges for the year ended 31st of May 2018, and we would also credit the £200 to an accrued expense account, and that journal would be dated the 31st of May 2018. At the start of the new accounting period, so on the 1st of June 2018, we would put through another journal to reverse that original journal. Now, what do we mean by reversing it? All I mean is that we put through the same journal, but the debits and credits are swapped round. So we will credit the bank charges with 200 and debit the accrued expense with 200. And that way, when we're looking at the books for the year ended 31st of May 2019, that £200 that was paid in that accounting year has been cancelled out and won't be recorded as a cost in that second year because it's already been recorded as a cost in the year ended 31st of May 2018. Let's now have a look at an example of how we record accrued income. Now, just to confirm, accrued income is where the business has delivered services or goods to a supplier before its year end, and so it can legally charge for that work or charge for those goods, but it invoices for them after the year end. So let's illustrate this. A business's year end is the 30th of November 2017, and on that date it delivered goods worth £3,000 to a customer. And then the next day, on the 1st of December, so after the year end, it issues its sales invoice to that customer. So that income of £3,000 is going to be recorded in the sales day book for December 2017, but in truth that income was generated in the year ended 30th of November 2017. So what we need to do, we need to record an accrued income adjustment at the end of 30th of November 2017 to make sure that that income is recorded in the correct accounting period. So at the year end, we're going to record a journal. Here we will debit an accrued income account with £3,000 and we will credit sales revenue with £3,000. That way we're including that those additional sales that need to be recorded in the year ended 30th of November 2017. And that is the date that this accrual would be recorded in the books. Then at the start of the next accounting period, so on the 1st of December 2017, we would reverse that previous year's accrual. So here we will credit accrued income with £3,000 and debit our sales revenue with £3,000. And that way, that £3,000 is only going to be recorded as a sale in the year ended 30th of November 2017, and it's not then going to be recorded in the sales for the following year, which is what we want to happen. So that is how we record accruals in our books.